Markets fell ahead of Thanksgiving holiday after the latest PCE inflation data showed inflation inched higher in October, but the broader averages are still each more than 5% higher for the month. Our next guest has a contrarian call on inflation, saying headline CPI bottomed out in September at 2.4% and says investors that prepare for higher inflation and higher interest rates will be rewarded. Michael Landsberg is Chief Investment Officer at Landsberg Bennett Private Wealth Management. Good morning. Good to see you. So tell us about this contrarian inflation call, because I think, we're seeing some changes in the bond market. Steve was talking this morning. We're seeing a sort of flattened curve right now. What do you make of what's happening, particularly with the 10-year right now, right at 4.2? So that's come down quite a bit over the past few weeks. And then, therefore, how does that fit into your view of what's going to happen with rates and inflation?
Robert, I think part of the reason it's come down recently has been, I think, the bond market likes what they saw with this recent appointment. And Scott Bessent's, a market participant. People like having somebody that's got credibility in the market. What's been interesting is the Fed's cut, interest rates 75 basis points, yet yields have jumped 65 to 75 basis points on, different maturities. So I think the bond market ultimately is like, I'm not sure we're really, believing what we're hearing from the Fed. A year ago, I remember, being on the show and people talked about 7 interest rate cuts. I was saying at the time we might see 3. I think people are overestimating what we're going to see in 2025. And I think it's because of inflation. I think inflation's coming back. You're seeing that with, coffee, cocoa, a lot of things that we eat, beef, lean hogs. Things are starting to kind of tick back up. I don't think we're getting back to 9%. But I think at the same point, I think the fact that the Fed and a lot of people think we're going lower, I think is wrong.
Well, that's interesting, because you said you feel that inflation bottomed out at 2.4% in September. You think it's going to go, to 3 to 3.2% next year? Is that going to be a first quarter? Are you talking the end of next year? And you mentioned copper, coffee. These aren't huge contributors to the economy. What are the components that you think are going to be really driving us back over 3%?
I only really look at the next 6 months. So I expect to be 3.2 in the next 6 months. What was interesting, when they talked about transitory a few years back, my models were looking at saying we're going to have 6 months in a row of increasing inflation. And I'm very similar in this circumstance. I don't see it going quite as high. But when they talked about when inflation and the war has been won, we looked at our data and said, okay, shelter prices are too high. Yeah. A lot of foodstuffs are now starting to head higher. And again, I don't think it's going to be back to the 9% numbers. But we've got it going basically by the end of the first quarter of 2025, is I've got 6 months in a row of headline inflation moving higher. We use headline simply because it models better for us than PCE. And again, I think PCE may have that tweak as well. But we're looking at that saying, okay, that's going to be an area where we've got to look at it and say, okay, if inflation's heading higher, if the rest of the street has it going lower, what does that look like from an investment standpoint? Where do we want to put our dollars in an environment where inflation is moving higher?
Yeah, so to that point, if you look at rates higher for longer, that would normally not be great for stocks. But you seem to be, and correct me if I'm wrong, fairly bullish on stocks, at least for the next 6 months. So what's your expectation for the stock market? And then where do you see the best sectors within the stock market, at least for the next 6 months?
Yeah, we're bullish simply because earnings have been great. I mean, S&P earnings, I think, are up 8% year over year. NASDAQ's up over 20. I'm not really a big fan of small cap. Small cap, I think, is still -4 year over year. Small cap, made an all-time high a week ago, but the interesting thing was it's barely up in the last 3 years. So you made no money in 3 years. So we'd still avoid small cap, but we look for those sectors like utilities, like energy, that we think will do well in this environment. I like insurance stocks from a pricing standpoint where you can build inflation and margins into your pricing. And I think those are the areas that are going to do well. I think healthcare is not going to be an area that's going to do well, given kind of where we are in terms of margins, but also you're having a different, kind of atmosphere, if you will, in Washington as to who might be in charge of what's going on with healthcare.
Michael, just very quickly, do you think the Fed should not continue to cut here? And if that's the case, is that your case against small business, small and medium-sized businesses, that they're not going to get relief on the interest rate front?
Absolutely, Steve. I think you're going to get one in December. I don't think that we should, but I think you get one. But yeah, I look at it from a standpoint of if rates go higher, the biggest companies in the world are not going to have that problem. A lot of tech companies don't have a lot of debt. So they're not going to be that problem. They're not going to have a problem getting credit. But small companies certainly are tough there. And again, that's on the balance. When I say the small companies, there's a lot of great small companies in this country, but it's a stock picker's market in small cap. You can't buy the Russell 2000, have made no money for 3 years, and think that's a good place to be. So I think you want to stay with, with the large cap sector-wise. We do favor, like I said, utilities, energy, and industrials.